All right, today we're diving into one of the biggest names in crypto right now, Athena. They're making a pretty bold claim that they can reinvent the stablecoin with this thing called a synthetic dollar. So, yeah, let's break it all down.
Okay, to really get why Ethena is such a big deal, you got to start with this number, $8.5 trillion. That's a sheer volume of stablecoin settlements on chain in just a single quarter of 2024. I mean, that's not just a big number, it's a statement. It tells you everything you need to know about the state of crypto right now.
And what that statement says is this: stablecoins are, without a doubt, the most important instrument in crypto. They are the bedrock, the foundation of this whole digital economy. Think about it. We're talking over 70% of all on-chain settlements, 90% of trades on order books. Whether you're in DeFi or just trading, stablecoins are the plumbing that makes it all possible. But, and this is a big but, this absolutely critical piece of infrastructure has a massive fundamental problem.
And that problem? It's a dilemma, really. A trade-off that has haunted the crypto space for years. Basically, when you're choosing a stablecoin, you've always had to pick your poison.
So on one side of the coin, you've got the big guys, right? USDT, USDC. Sure, they're stable, but they're also completely dependent on the traditional banking system, which means they come with censorship risk. And here's the real kicker. You, the user, take on all the risk, but the company behind it gets to keep all the profits from the collateral. Then, on the other side, you have all these decentralized attempts, and bless their hearts, they tried, but they've always been too fragile, or they just couldn't scale, or they had serious liquidity issues. So what everyone in crypto has been looking for, I mean, desperately searching for, is the holy grail. You know, a crypto-native form of money that actually checks all the boxes. It needs to be scalable, it needs to be stable, and it has to be censorship resistant. And this, right here, is the problem Ethena claims it can solve. So what's their big idea? It's called USDE, and they refer to it as a synthetic dollar. The whole point is to create an entirely new category of stablecoin, one that, in theory, gives you the stability of the big guys without the censorship and the decentralized ethos without the fragility. Okay, synthetic dollar. What does that even mean? Well, think of it like this. Instead of being backed by dollars sitting in a bank somewhere, USDE is backed by other crypto assets. And I know what you're thinking. Isn't that super volatile? And here's the magic trick. The protocol uses derivatives to hedge against that volatility, basically canceling out the price swings of the crypto it's holding. Now, that might sound a little complex, but the mechanism behind it is actually pretty clever. So let's pop the hood and see how this engine actually works, how USDE gets minted, and more importantly, how it stays pegged to a dollar. All right, so the whole process is automated. Let's say you come along with about $1 worth of a whitelisted asset, like USDT. You deposit it, instantly the Ethena protocol mints you 1 USDE. But at that exact same time, something else happens in the background. The protocol automatically opens a short perpetual position for that same dollar amount. That's the hedge. And get this, your original asset never even touches the exchange. It's kept safe with a special off-exchange settlement provider. The core concept that makes all this possible is called delta neutrality. It's a fancy term, but the idea is simple. Picture a perfectly balanced seesaw. On one end, you've got the crypto asset Athena's holding. On the other end, you've got that short position, which is basically a bet that the asset's price will fall. So, if the asset price goes up by $1, the short position loses $1. If the asset price goes down $1, the short position makes $1. See? They cancel each other out perfectly. The seesaw stays level, and the total value stays locked at $1. And this custody model is another really important piece of the puzzle. Just to be clear, the assets backing USDE are not sitting on the exchanges. Nope, they're secured with institutional-grade off-exchange custodians. This lets Ethena use the assets for margin without ever giving up full custody. Why does that matter? Well, it massively reduces counterparty risk. If any single exchange goes bust, the protocol's assets aren't trapped there. Okay, so we've got a design that's scalable and in many ways more secure. But you're probably asking, so what? Why should I hold this instead of something else? What's the actual incentive here? Well, the answer is pretty straightforward. Yield. You can stake your USDE, and in return, you get SUSDE, staked USDE. And this SUSD is what captures all the rewards, all the native yield that the protocol generates from its core strategy. But where does this yield even come from? It's not magic. It's actually a natural part of how derivatives markets work. Remember those short positions? Well, in these markets, there's something called a funding rate. It's basically a payment that helps keep prices in line.
Because of its delta-neutral strategy, Ethena is set up to collect these payments. And in 2024, those rates were pretty significant, averaging over 11% on BTC shorts and nearly 13% on ETH. And what does all that mean for the user? Well, it translates to this incredible number. In 2024, the average APY for USDE holders was 19%. And just to be clear, this isn't some made-up number. It's not like interest from a bank. This is real yield generated directly from the mechanics of the crypto market, and it's passed directly back to the people holding the token.
But honestly, the vision here is so much bigger than just a single high-yield stablecoin. What Ethena is really trying to do is build the foundation for a whole new financial ecosystem. They've actually launched something called the Ethena Network, which is all about encouraging builders to create new financial products on top of SUSD. And it's already happening. We're seeing new exchanges pop up, protocols for structured risk products, options protocols, all using SUSD as their base collateral. So you see, it's not just about one product. They're trying to become the new financial plumbing for the entire DeFi space. And that really brings us to the big final question, doesn't it? For so long, crypto has been caught in this impossible choice. You either accept the risks of centralization or you deal with the fragility and scaling issues of decentralization. Ethena is stepping into the ring and offering a third path. So, could a synthetic dollar, backed by crypto but stabilized by derivatives, be the thing that finally solves the stablecoin dilemma?